The market has fallen sharply over the last couple of weeks, and then there was a big fall here also. And after this fall has happened, many people are curious that were there any signs that you could have picked up for this fall if you are a student of Wyckoff or auction market theory. So I'm going to tell you how Wyckoff and auction market theory principles helped when this whole development was happening and how you could apply them to catch such moves. This is not a trade recommendation, this is not a trading setup. It's just studying the market behavior and trying to isolate some high probability trade ideas. So what is happening here? Market is going higher and it encounters some opposite activity and it goes sideways. See, if buyers have absorbed all the sellers, the auction will go up to find sellers. If it finds sellers at a particular zone, then buyers and sellers will be in balance briefly. For that period, the market will go sideways, and again, if buyers absorb all the sellers, market will break out and go up again until it reaches a point where sellers have completely overpowered the buyers. There are no buyers in the market, so auction will go lower now to find buyers, and that is when you get downturns. Alright, with that clear, let us look at this. So market goes higher, moves sideways. Why? Because some opposite activity has come, but then buyers just overcome that supply and it again goes higher. Finally it puts in a top, comes down, consolidates, tests back again this high. Why is this high being tested again? And the reason is very simple. Let's say some higher time frame traders, investors, they want to sell, they want to get rid of their portfolios. Now you need to understand that their portfolios are huge. It's not 100 shares of Infi, it's not 100 shares of Reliance, which is a big deal for retail traders. These are hundreds and thousands of shares of multiple companies. So if they want to get out of their portfolio, it is going to take them time. Now imagine if they sell their portfolio here and instead of going down, market goes back up. They will look like a fool and they will miss out on a lot of profit. So they have to keep testing whether other traders are also thinking like them and thinking about selling their portfolio. So what they do, they test. And what they are testing for? Any pending buying interest. Why buying interest? Because let's say markets go higher and new traders join in, then this trend can continue and that will be a bad thing for their position if they are getting out of here, right? So if they sell at this high without testing, and when the market comes here and market just continues to go higher, they would have missed out on big profit. So what they do, they test. Now they realize that okay, even after going higher, no buying is coming in, market is falling sharply. This is the consolidation where majority of their position is sold. Obviously some is sold here, some is sold here, some obviously will be sold here, some of it will be sold when the market was going higher. So all this testing and checking whether other participants are also doing the same thing happens in this area, and that is what gives rise to a consolidation. So once again, what is happening? First, some supply comes in, market goes sideways, then we go higher, then we put in a high, come back down, consolidate, test, come back down. This time you come to a support, market does not bounce, market falls, and now hopefully there will be a bigger down move. So now if I have to look at it in terms of Wyckoff, what I am seeing here, this is the primary supply, this is the buying climax, this is the consolidation phase, this is the test, this is absorption of demand, and this is the trend phase. And if I have to put the phase letters on this, this is A phase, this whole thing here is a B phase, this test is a C phase, this absorption of demand is a D phase, and this is your E phase where the trend starts. I hope you now get how Wyckoff could have helped you. Now, what happens is, not all corrections will develop like this. Not all corrections will be as clean as this one is. So what you do, you simply try to find ranges. You try to find ranges in the stock market. if you can find some ranges in the stock market, your trading will become extremely easy. And what you do once you find these ranges, again this one, okay, we forget this one. Once you find these ranges, you try to find what the market does at the extremes of these ranges. So at the top, when you go at the top, you get quick rejection. When you come at the bottom, the rejection is slow. And this time, instead of rejecting, we break down. So this becomes absorption of demand. And whenever you are reaching the extreme of a consolidation, what is expected? Rejection. That is the expected behavior. Once you stop getting that expected behavior, that is your first warning that something is changing and the consolidation might break. Which side it will break? The side where you are getting unexpected behavior. So this absorption of demand is unexpected. This is where you should find support and market should go higher. It's not happening. It is just staying here. That means whatever demand is coming in, it is being absorbed by the sellers, and now the auction is likely to break down. So just following the range trading formula. What is that? Very simply, identify a range. The expected behavior at the top of the range is rejection. At the bottom of the range is rejection to the upside. Here rejection to the downside. So if we do not get rejected and spend time around the top, this is unexpected behavior. If we come to the bottom, do not get rejected and spend time, this is again unexpected behavior. And what should you expect? In majority of the cases, you will see a breakout or a breakdown. But what if it comes back down? Then the range continues and you keep monitoring the range. As long as this kind of behavior is not visible, you should not be bothered. Alright? If there is a quick rejection, then somewhere along the way you can enter for a test of the opposite side. So if I have to give you an example, this point establishes the range, okay, this high, this low, this HVN also. And now when you come here and you see rejection, you try to find intraday selling opportunities on these days to capture the rest of the move. But if there is no rejection, like you try to reject, come back down, try to reject, come back down, and you start making a range, then you wait patiently for signs of a potential breakdown and then trade the rest of the move. So if you do that, Wyckoff will help you. And as I said, auction theory is very, very simple. It just tells you market goes higher to find sellers, market goes lower to find buyers. So here market was going higher to uncover sellers. As it uncovered sellers, it comes down. Now as it comes down, here at the low of the range, bottom where buyers are supposed to come in, if the buyers do not show up, what will happen? The auction will continue. And as long as the auction is continuing down, what do you know for sure? That buyers are not yet uncovered. So don't look at these sharp reversals and start concluding that buying has come in. No. Wait. Let the market show you clearly that it wants to go higher, it is forming higher value areas, and then you can take some intraday positions in the direction opposite to that particular reversal. Like if this reversal is from down to up, you try to find long trades. If this reversal is up to down, try to find short trades. But don't jump to conclusions. Don't try to get ahead of the markets. Let the market tell you what it wants to do, and then you follow the markets. If you have more such questions, please let me know in the comments, and the next video I will make will be answering your query.